In the recent Federal Open Market Committee meeting, they did not raise rates, but they did set the stage for an additional drain on liquidity. The stage is now set for asset repricing, which is a gentle way of saying a market crash. The more money chasing stocks, bonds, and real estate, the higher those assets will go. But the opposite is also true. Since central bank stimulus was introduced, and up until September of last year, $60 billion per month was infused into global assets. In fact, during the stimulus, they told us what they were going to buy, when they were going to buy, and how much they were going to buy every month in advance. The purchases and stimulus pushed the S&P 500, the Nasdaq, the Dow, and the Russell 2000 to excessive valuation levels. At the end of January this year, the S&P 500 was at 25 times earnings. That made it the most expensive bull market in history. The $60 billion per month infusion by the central banks pushed up assets relentlessly. Now, however, that has changed. Stimulus is not only over, but the central banks are now a drain on liquidity. Where before they were adding $60 billion per month, they are now draining $30 billion per month, a $90 billion difference. But they also told us something more. The FOMC basically said they are on pace to continue doing what they already said they would do. They also laid out a roadmap to remove more liquidity. Reportedly, they will remove an additional $40 billion a month beginning in July. Currently, they are a $30 billion per month drain, so in July, they will be a $70 billion monthly drain on liquidity. A few short months ago, they were a $60 billion net stimulus. Again, in July, they will be a $70 billion drain. That's a $130 billion difference just in 9 months. So the stage is set, and I think what we see in the markets right now is the repricing. So let's take a look at other indications. At the Strategic Investment Conference 2018, David Rosenberg of Gluskin Sheff warned investors of the coming mean reversion in the stock market. Rosenberg admitted that this is one of the strangest rallies of all time. That's because all asset classes went up, even the ones that are inversely correlated. Rosenberg pointed out that increasingly more hedge fund managers and billionaire investors who timed the previous crashes are backing out. One of them is Sam Zell, a billionaire real estate investor. Rosenberg admitted that Zell is one of his heroes, and Sam Zell predicted the 2008 financial crisis 8 months early. But essentially, he was right. Today, Zell's view is that valuations are at record highs and the easy money has been made. And showing this chart, Rosenberg suggests that equities are poised for a major correction. For starters, he pointed out that only 9% of the time in history have U.S. stocks been so expensive. And this is the cyclically adjusted price to earnings ratio going back to 1925. And as you can see here by the red circles, the peak at the far right, we're at the third highest level on this chart. Let's go to the next chart. At the conference, Rosenberg showed a table with GDP growth figures in the last 9 bull rallies, and the table reveals a trend where each subsequent bull rally in the last 70 years generated less GDP growth. Essentially, that means we are paying more for less growth, or in other words, we are getting less growth for our money. And Rosenberg states that historically, you get a 17% growth rate in a bull market with nominal GDP at 7 and real GDP at almost 4. This time around, we did it with 3.6% nominal GDP and 2.1% real GDP. So we basically had a typical bull market in the context of economic growth that was barely half of what it normally was. And according to Rosenberg's calculations, the S&P 500 should be at least 1,000 points lower than it is today based on economic growth. Another historically accurate indicator that predicts the end of bull cycles is household net worth share of personal disposable income. And as you can see here in the chart, the last two peaks in this ratio almost perfectly coincided with the 2000 dot-com crash and the 2008 great financial crisis. And so here we are in 2018 sitting at an even higher point on the chart. And even the Fed thinks a mean reversion is coming. According to the Fed's own words, current valuation ratios for households and businesses are high relative to historical benchmarks. We find that the current price to earnings ratio predicts approximately zero growth in real equity prices over the next 10 years. And so we find ourselves in the middle of a Fed tightening cycle. And as history shows, a tightening cycle is almost always followed by a recession. So basically, the Fed is giving investors an explicit warning that the market will mean revert back to the mean. But when we revert, we don't stop at the mean. We go beyond. So for today, that's ChewDog Charts. Thank you.